I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Made. It's a podcast where we will help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, for the very last time this year, I am joined by my equity buddy, Ren. How are you going, bro?
I'm good, Bryce, except I actually think it's the second last time this year.
Oh, always get me on the technicalities, don't you?
Well, mate, come on. Our listeners expect a certain level of accuracy.
This is true. For the second to last time, look, I'm obviously sad that the year's coming to an end.
No, you can't wait for it to finish fast enough. You're skipping one episode ahead.
All right, fine. For the second last time this year, we are back on air before the Christmas break. And today we have the last interview from an expert investor for 2018. And in my opinion, it's probably one of the better ones that we've had this year. So we're certainly going out with a bang. Would you agree, Ren?
Yeah, definitely. And that's not to disparage any previous guests. That's just because I think we've both probably been a fan of this guest for a long time. Yes. And to get to speak to him was pretty exciting.
So we were lucky enough to get an hour or so with a guy called Jesse Felder, an investor, ex-hedge fund manager, and now blogger and podcaster.
Should we say a senior member of financial Twitter and the financial media? Yes.
So he's done it all in finance world and is very much in line with the way we think. We resonate a lot with his way of thinking and his views of the market. So it was an excellent and exciting opportunity for us to sit down and pick his brains on a few of the topics that we've been discussing throughout the year. For those listeners that remember, we actually dissected one of his quotes when he was on a podcast called The Investors Podcast to do with the buy and hold cult. And it was that episode that triggered us to get in contact with Jesse and discuss that topic a bit further. So Ren, do you want to give the listeners a bit of a rundown on Jesse himself?
I think you've done a good job. If people want to follow Jesse, they can jump on Twitter. He's pretty active there. He's got a website, the Felder Report. He produces research for hedge funds and high net worth individuals, but he also produces a lot of free stuff that anyone can read. You can subscribe to the Felder Report's mailing list, and he's actually a fellow podcast host. He hosts a podcast called Superinvestors and the Art of Worldly Wisdom. But yeah, look, really smart guy, really interesting thoughts on the market, and really enjoyed this interview.
So without further ado, we all hope you enjoy this interview as much as we did. As Ren said, we were definitely fanboying a bit at the throughout. So
especially at the end, you were literally fanboying at the end.
I was. So enjoy. Well, Jesse, we always like to get an understanding of where our guests have sort of come from, how they are in the position that they are today. So let's start with your very first investment. Can you remember what your very first investment was and what led you to make that decision?
Yeah, actually, my first real investment was probably, I can't remember which actual mutual fund was. It was probably a mutual fund right around the time when I was in college, and I had saved some money, and I was trying to figure out what to do with it. And the bank sold me like a money market fund, and then I wanted to do something, more with it. But I actually started paper trading when I was really young. I was like 9 or 10 years old, something, and I started actually I guess you can't really call it paper trading, but I started tracking some of my favorite companies, just the stock prices of them from week to week. I'd look in the Saturday Barons and, write down, okay, Coca-Cola's at this price, or, what have you. And so I just started kind of tracking companies that I was interested in back then. But probably the first real individual stock I bought was right around the time I first got into the industry and heard about Warren Buffett, and I had to buy some Berkshire Hathaway. So that was probably my first individual stock.
Yeah, I think that's probably a lot of our listeners' first stock, and it's probably been a good choice for you. Are you still holding it today?
No, I had decided at some point that that I think holding Berkshire was very similar to just holding kind of like an index fund or something. And I can't remember when I sold it, but it was a while ago.
Mm.
Now we know you have thoughts on indexes, but we'll get to that in a second. So you started your career at Bear Stearns. What did you learn from your time on Wall Street, and are there any misunderstandings that people have about the way Wall Street operates?
Yeah, I had a huge misunderstanding when I went to go work at Bear, and I never worked back east. I worked in the LA office, and they sent me back east just to kind of meet, when I first got hired, just to meet the guys at the main office, and their floor trader took me, on a tour of the New York Stock Exchange, which was pretty fun, and that was back when the exchange was a little bit more busy than it is today. But my biggest misconception was that, I'm going to go to work for essentially the biggest firm on Wall Street at the time. They were doing more business on the exchange than any other firm. And so this is going to be a great place to learn about how to make money in the markets. And the guys that I went to work for at Bear, I quickly realized they weren't even very interested in trying to make money in the markets. They were really just trying to make money from commissions and off of their clients rather than for their clients. And so for me, that was kind of a big eye-opener, and I had no interest in becoming a salesman or anything like that. So I had to find somebody to go work for who could actually teach me about the markets. And that's been my experience, and I think that's a misconception a lot of people have, is that Wall Street's there to help you make money. And really, Wall Street's number one MO is to make money for themselves. And so there really is just a massive conflict of interest there.
Interesting. So who did you then manage to go and find that could teach you, how to make money in the markets?
So there was a guy at Bear who I went to, who was basically running kind of a hedge fund inside Bear Stearns and some separate accounts, and I went to work directly for him, and kind of got to see firsthand what he was doing, what his process looked like, and my first real job was just running tickets to the trading desk. So that was back before we could do any trading on computers, and we'd have to write up a buy or sell ticket and then run it to the guys at the trading desk, and they would process the trades. And so that was kind of my first job at Bear, was just running those tickets. And so I got to see every buy and sell order that he was placing, and then you can start to look at the things that he's, I'm sitting shoulder to shoulder with him on the kind of like at the trading desk, so to speak, in the LA office. And so I could hear every phone call. I could, watch everything, see everything he was reading, and basically get a real kind of firsthand look at how you go about managing money.
So after your time at Bear, you co-founded a hedge fund. What was the experience like starting a fund, convincing investors to let you manage their money, and how did it differ from your time at Bear?
Well, I never was on the side of raising money. When we started the fund, there was really just four of us, and I was the assistant portfolio manager and head trader. And the trading actually took up the vast majority of my time, because we had our own broker-dealer, and so I was processing trades for at least two other hedge funds and a couple other mutual funds that would run their trades through us. And so we kind of did we had our own research, department that essentially my partner and I ran. He really did most of the work, but they would pay us for research essentially by processing trades through us. And so I was just basically, running a trading desk by myself for the first few years, and then these other funds were not just buying stocks we were recommending, but they were processing almost all of their trades through us. So this would be buy 50,000 shares of SPY, sell 100,000 shares of QQQ, and just kind of that was my 6:30 West Coast time, 6:30 to 1 p.m. trading day was basically just that. And then so after 1 was the time when I had time to kind of start doing research on my own and looking at individual investments for the funds and that sort of thing.
So Jesse, about a decade then after you left the hedge fund, we've seen that it fell apart in sort of quite spectacular fashion. What was it like from your point of view, watching something that you'd built, I guess, fall apart?
Yeah, I was really only there for a few years, and the reason I left was because I could, I hate to say I could see that coming 10 years prior, but I really didn't like the mindset of my partner, and I really felt like he was not as committed to doing things in an ethical manner as I was, comfortable with, and so that was really one of my main reasons for leaving. And so it wasn't a surprise to me at all that it kind of happened, went down that way. Like I said, that was part of the reason why I left, but I couldn't have imagined, all the stuff that kind of went down after I left.
So Jesse, coming to today and what you're doing now, you run the Felder Report, an in-depth monthly investment newsletter, and you also host a fellow investing podcast. So how have you found being on the media side of the financial industry? Has it changed your perspective at all?
Yeah, it's taken me this long, 20 plus years in the business to figure out this is where I want to be. I think, when you figure out what it is you love about something, that's kind of an important epiphany. It was for me. And for me, the side of the business that I've always loved is the research side of things. And so to be, able to focus on that, for me is really a blessing. And so, it's I don't know, sometimes it takes a while to figure that out, but for me, I've always enjoyed writing. I actually studied English in college. I didn't study any business or economics at all, and I've always enjoyed writing, and so to be able to put those two together is really ideal for me.
So Jesse, I just want to pick up there. Sorry, Ren. If you didn't study business or economics, how did you actually end up getting into the markets? Like, how did you end up at Bear? Honestly, Bear really liked the fact that I wasn't, I didn't have a lot of preconceived ideas and how things should work. I even after I left the hedge fund, I thought about getting an MBA or doing CFA or something, and I remember, reading one of the first things I did when I came into the industry was I went through and I read all of the Buffett letters. I was reading the Wall Street Journal, cover to cover, and that was something else somebody told me to do. But reading Buffett really is an education in itself. And he said a lot of times, it's funny that at business school they teach you a lot of the wrong things, and efficient market hypothesis and all these things are can be counterproductive to at least becoming successful in the markets the way I wanted to. And so for me, I found that I don't want to spend time, studying these concepts that, the greatest investor of all time says have little or no value or actually could be counterproductive to your success in the market. So I basically just said, I'm going to create my own curriculum, and I'm going to study Buffett and read everything I can get my hands on and study all of the greats in the business, and see if I can't figure out how to put that into my own investing style. Yeah, wow.
It's interesting because a lot of our listeners have come to investing late as well and haven't studied it at uni. So, for those people, or for people who are just leaving school and thinking about what they want to study at uni and are interested in a career in finance, would you say go the traditional route, or would you say go the Jesse Felder route and teach yourself?
I would say, it takes a lot of motivation to, it's like working out, right? I mean, there are people who can go work out at the gym and get a great workout on their own. And then there are other people who really need a coach to motivate them. Otherwise, they're going to just kind of go through a half-hearted workout in the gym. And if you're super passionate about it, then you'll learn, and you'll be curious enough to just kind of read through tons of stuff. And I think honestly, if you can go study with one of the one of the great business schools, that maybe it's somewhere with that has a program that's dedicated to value investing in the line of great value investors, then that can make sense. But really, if you're going to spend a ton of time learning economics and all that kind of stuff, it has, I think, very little value overall. Buffett has said you need a third grade education in math, and I think most even macro investors would tell you just need a basic understanding of economics in order to begin to learn how to make money in these markets. It's more about what they don't teach you in school than it is what you can learn in school.
Mm-hmm.
Yeah, definitely. So if we can go back to financial media and your time running the Felder Report, when you think about the financial media landscape more broadly, do you think that as an industry we're doing a good job improving our customers' financial literacy?
I think as an industry it's getting a lot better. I really do. I think to see podcasts like yours, and you guys are truly curious about, finding out what's true and how to, and really passionate, obviously, about helping people become better investors. That is something that is an extremely valuable mission to your listeners. And I think in the past we've seen a lot of media is not necessarily driven, by such an altruistic mission. It could be more along the lines of, right, we need to sell advertising to big Wall Street firms or what have you. So I really think, especially with the new media like podcasting, I think it's getting a lot better.
Let's talk some basics, Jesse. What's something you think that beginners should understand better about markets when they start out investing?
I think the first thing that people should really understand is rather than trying to be successful or like hitting a home run or is look to limit your mistakes, right? Don't fall in the same pitfalls that everybody else falls into, because you see them classically over and over and over again. People do make the same mistakes. And, I can't remember the exact quote, but even Charlie Munger has said, that he and Buffett, seek most of the time to just not make mistakes. And if you can limit the number of mistakes that you make, then you're going to be way, way better off than most investors. And so, those mistakes are, classically paying way too much in fees. That's a big one, maybe the biggest one. The other ones are just being too aggressive and overconfident. And so, that can be expressed in investing in something you don't really understand, whether that's residential real estate during, the dot-com mania, or more recently cryptocurrencies. Or it could just be, being too aggressive in terms of something like home country bias. So, here in the United States, a lot of people have, big allocation to equities, which they don't understand. That is an aggressive, kind of active decision right there. But then that's, majority, if not all, invested in the United States, which home country bias is another big, I think, mistake that people make, just being overly aggressive and not realizing that they're being overly aggressive. So I think, just being overconfident, is probably something people should realize. There's actually one of my favorite quotes from the Jesse Livermore book. I can't remember the name of it right now, but it's one of my favorite books. He says, "The average American is from Missouri everywhere and at all times." Missouri's the show me state, for those of you guys who don't know. From Missouri everywhere and at all times, except when he goes to the broker's office and looks at the tape, whether it's in stocks or commodities. The one game of all games that really requires study before making a play is the one he goes into without his usual highly intelligent preliminary and precautionary doubts. He'll risk half his fortune in the stock market with less reflection than he devotes to the selection of a medium-priced automobile. And find that all the time. People go into investments, they buy insurance products that are linked to investments, all these things, and they do less research than they would in buying a car. And your investment, decisions are going to have such a much bigger impact on your financial life. And so just having that, normal skepticism about buying a product, about investing in something that you don't fully understand is a healthy thing that people should do.
Great advice.
Yeah, I think that's very good advice, and something that people who invested in crypto are probably taking to heart at the moment. So those were some pieces of good advice. On the flip side, what's some of the worst investing advice you've ever heard?
Oh gosh, there's so much bad advice out there. It's really hard to say. I think there's a couple things that just come to mind. First is when anybody tries to give you an investing advice, you should really do your own homework. I think taking stock tips is a bad idea. So just taking somebody's word for something is not a good idea, for the most part. But I think even more important than that, it's more kind of a life advice thing in terms of career in the finance industry is, so many people are interested in trying to find success in terms of, I want to work for somebody who's, very wealthy or who's been very successful in, those types of superficial ways. And I think, the advice I try and give to people is different than I got when I was starting out, which is find somebody who you really admire, not just from a professional standpoint, but from a personal standpoint, and go learn from that person. Because if you don't admire somebody, personally, not just professionally or what they've accomplished in superficial terms, the likelihood is you're going to discover that they're not somebody you really want to model anyways. And so, I think, that advice of, go work for the biggest firm on Wall Street or go work for the most successful guys in the business is not great advice.
You spoke about home country bias there, Jesse, and we've interviewed, Mir Statman and a couple of other guys who talk about behavioral investing and behavioral finance. So of all cognitive biases that investors are influenced by, is there any one particular that you think beginners should be focused on being aware of or watching out for?
Absolutely. I think one of the biggest mistakes investors make comes back to recency bias, is looking at what has happened over the last 1, 3, 5 years and extrapolating that out into the future. And people do that in so many different cases. I mean, this is essentially what drives a bubble in any asset class is recency bias. Well, look what it did over the last 3 years. It's going to do that over the next 3. And people just make that assumption. And that's really something that's deeply ingrained into our psyches, is to kind of extrapolate. But it's also, very, very dangerous to do that because, as you see with any bubble or any market, markets do not just trees don't grow to the heavens, right? I mean, there's a limit to everything, and if you are going to try and make that type of an extrapolation, you really need to have a very good reason for believing that something's going to continue, other than the fact that it just has done so over the last 5 or 10, even 40 years. So I really do think recency bias is one that's probably the most dangerous.
So it's probably a good time to talk about the current market, given we're just touching on recency bias, and we've seen some pretty big valuations at the moment, and some of your writing on the current state of the market we've found very interesting, and I guess a little bit of a different perspective from the mainstream. So to frame this discussion, I want to start with an economic indicator I've heard you discuss before, and that's the total value of the stock market against the total value of the economy, which is colloquially known as the Warren Buffett indicator. Can you tell us why this is an important metric and what it's telling us about the current state of the market at the moment?
Yeah, back in I think 99 or 2000, right either before or just after the peak of the dot-com mania, Warren Buffett wrote 2 different pieces for Fortune magazine. And I can't remember which piece actually highlighted this measurement, but he called it, probably the single greatest measure of where equity valuations stand at any given time. And I think the reason that he looks at it that way is that, you know, they should have a pretty close relationship over long periods of time. That the stock market can't grow much faster than the economy can grow. And then when you look at this measure and you compare it to the forward 10-year returns in the stock market, they're very, very highly correlated. And to me, this is the best demonstration of the Buffett quote, "The price you pay determines your rate of return." So you pay a high price, you're going to get a low rate of return. You pay a cheap or low price, you're going to get a high rate of return. And this measurement is just a perfect visual representation of that iron law of the markets, as my friend John Hussman calls it. And so, you know, today, this measure is essentially as high as it was at the peak of the dot-com mania. So it's essentially forecasting a negative 2% return per year over the next 10 years for the stock market. So, you know, now that has some embedded assumptions in there that we could talk about too if you want, but essentially the stock market's only been as highly valued as it is today during the dot-com mania and then back at the 1929 peak.
So given that equity valuations now are, I guess, at reasonably historic highs and the forecasting, you know, negative 2% returns over the next 10 years, how are you practically approaching equity investment at the moment? I mean, we all have our own strategies on how we tackle this period of time, but from your point of view, what are you doing at the moment?
Well, yeah, I've you know, since my hedge fund days, I really have, well, even back then, I really kind of bought into the idea of being long and short almost all the time. And so we're trying to buy things that I think are cheap and then sell short things that I think are not just expensive, but probably in a downtrend, and have some type of a catalyst for, you know, the price going down over the next couple of quarters. And so, you know, I'm long and short. And, you know, but for me, from the standpoint of the broad U.S. stock market being extremely overvalued, in my view, I don't want to have any exposure to the U.S. stock market, any net exposure or general market risk. And so for me, I want to be fully hedged in some way or another. Now, this is not to say that I'm not like finding any good ideas on the long side. I actually, over the last couple of years, have been finding, you know, a number of great ideas on the long side. So, you know, just because I'm very cautious on the broad market in general doesn't mean I'm not taking advantage of things that I find. In fact, this is something I try and tell people too, is that I've never allowed my macro concerns to get in the way of micro opportunities. It's to me, I've always made a mistake when I've done that, because when I find a very compelling opportunity, when I've allowed my macro concerns to get in the way, it's usually cost me. You know? So it's something I just don't do.
So Jesse, you said there you didn't want any net exposure to the US market. When you look overseas, where do you think the greatest risk and opportunity lies?
Well, you know, emerging markets are looking pretty darn cheap. They're out of favor. You know, I really feel like my, you know, expertise, if I have any at all, or my real confidence level is in investing in individual U.S. equities. That's where I probably have my greatest confidence. And so looking outside the U.S. is kind of outside of my comfort zone. But to me, it does look like there's some opportunity. I mean, Brazil's hated, Mexico's hated, China's pretty hated. You know, to me that's pretty interesting from a contrarian standpoint, from a valuation standpoint, and then also from the standpoint that I'm bearish on the dollar over the next few years. So I think all those things kind of conspire to argue for some type of exposure to emerging.
So back to the US, corporate debt levels are also at reasonably historic levels at the moment, and this is something you also write about. Can you explain for our listeners what impact this actually has for an investor?
Yeah, you know, I think it's very interesting to look at these, and it's, you know, when you actually add this to like a Buffett measurement, Have you guys had Toby Carlisle on the podcast yet?
Yeah, we have, actually.
Okay. Well, Toby, those who are familiar with Toby's work understand, the acquirer's multiple. You're not just valuing the equity side, of a corporate valuation. You're looking at it more holistically. You're looking at the balance sheet also. And so when a company has net debt, if you're a buyer of a company outright, like Warren Buffett, you're going to have to look at the balance sheet, because even if you just buy up all the equity, you're still going to be on the hook for the company's net debt. Or if they have a bunch of cash and no debt, then that cash is going to be like a rebate on your purchase price. And so you have to look at enterprise value. And so when you look at the broad U.S. stock market and you don't look at the debt side of the equation, you're kind of missing the fact that corporate America has levered up in the process over this past cycle. So when you look at enterprise value of the overall U.S. stock market, and that's debt and equity relative to the economy. So this would be kind of like a modified Buffett yardstick. Valuations are higher than ever before. We're past the dot-com mania. So, to me, that's an important thing to consider, and also, where we are in the credit cycle too. So leverage has gone way up. If you study Minsky, he talks about 3 different stages of the credit cycle, and you start out with loans that are backed by assets, that are backed by hard assets. Bankers are only comfortable making these types of conservative loans, and then as the cycle progresses, they start lending against essentially interest coverage, lending against earnings. Then as the cycle progresses further, you start getting into what he calls Ponzi type of finance, where lenders become comfortable giving money to companies who don't even earn enough money to pay interest on the debt. And these are, he hasn't called them these, but the IMF and some other places have called these zombie companies. And the percentage of zombie companies in the S&P 500 is higher than it's ever been, even during recessions. It's something like 20% of companies in the S&P 500 today are zombies, meaning they don't earn enough money to pay interest on their debt. Minsky called this Ponzi finance. And when these companies, when the credit markets stop funding these companies, that's when you start seeing a credit cycle turn down. And so I think we're possibly, with the widening in credit spreads we're starting to see over the last couple of months, we could be nearing that type of stage in the credit markets, and just due to the amount of leverage that's out there, and then also the amount of investor protections that have been removed during this cycle, it could make for a pretty painful cycle in corporate credit.
Yeah, that's pretty scary if 20% of the S&P 500 are these so-called zombie companies. And I guess that probably leads quite nicely onto what might be the most controversial part of our discussion today, which is the passive investing, or as you've named it, the buy and hold cult. So as a podcast, and over the last year and a half, we've been pretty convinced by the underlying logic around ETFs and passive investing that it's difficult for individual investors to achieve market-beating returns over a long period of time. So maybe to start with, why are we wrong?
Well, first of all, I have to say that I don't think you're necessarily completely wrong. I think what I'm more worried about is these types of things where you see, an 80-year-old man with 80% of his money in the U.S. stock market. I teach a class here through the local community college that teaches people to build a low-cost, diversified portfolio. But it's when you look at big endowments and the most successful asset allocators on the planet, they have very little exposure to U.S. stocks. It doesn't look anything like a 60-40 portfolio. It's much more diversified, and so that really is a message that I think most people need to hear when I'm talking about this stuff. Is it's fine to use index products, but if you're just putting 100% or 90% or something in the U.S. stock market, then you're not passive. You are actually making a very aggressive, active call on the U.S. stock market. So I think the way I think about this right now is George Soros said stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality is distorted by a misconception. And so I think I strongly believe we're currently in a stock market bubble, and I think it's been driven by a couple of important misconceptions. And the first one is, and they're relative, they've inspired a lot of investors to become passive investors. The first misconception is that people believe you just put your money into the U.S. stock market, and then regardless of the price you paid, you're guaranteed to make a good rate of return over a long period of time, so long as you're at least willing to hold for at least a decade. And, I've heard people say things like, well, there's never been a 20-year period in the U.S. stock market where you haven't, been made whole. And so there's this belief that time heals all wounds in the U.S. stock market. And that's just not the case. That's a distorted reality that people believe. There have been long periods of time in the stock market where you made no money. And actually, there was an interesting paper that came out last year called Stock Market Charts You Never Saw. And I have to give Grant's Interest Rate Observer a hat tip for bringing this to my attention. But in this, the author, who's a Santa Clara University business school professor, highlights these times in the markets where long periods of times where you didn't make any money. And in real terms, before dividends, he points out, this is the most extreme example of this, that from 1929 to 1982, 53 years in the U.S. stock market, if you had held on for that 53-year period, you would have actually lost 40% of your money in real terms over 53 years. So these are the stock market charts that he's saying, people haven't seen. And this is also, goes right to that misconception. I think people believe as long as I just hold on long enough, the market will come back and time will heal all my stock market wounds. That's just not the case. And sometimes, how many people actually have a 50-year time frame? Most people don't have a 50-year time frame. They have maybe a 20 or 30-year time frame. And there's 20 and 30-year time frames, periods in the stock market that have been very, very painful. And he highlights these in the paper. So, I do think that's a misconception people have about it. I also do believe that the idea of passive investing is another major misconception that investors have. I contend that there is no such thing as passive investing. There's another paper that came out recently that showed that every single index is an active construction in some respect. There is no such thing as just buying the stock market. And I interviewed Steve Bregman about this about 18 months ago because I think he makes the best point here, which is most people don't realize that the indexes were modified just over a decade ago. So it's not just ranking stocks by market cap. It's ranking companies by float-adjusted market cap. And so when you have companies that are run by owner-operators and the insiders own a ton of stock, their shares are not counted in that company's market cap for indexing purposes. So those companies are systematically underweighted by the index. And studies show that the most successful stocks in the market over longer periods of time are these owner-operated companies. So to me, passive investing today, this is one of the biggest problems, is you're actively underweighting the most successful stocks in the index. I think the best example of this, if you look at the stock price of Intel, from the day it went public to 2000, stock price went up like 1,000% or something. And that was the time when Andy Grove was running the company, and he owned a ton of stock. He owned like a third of the shares or something. Andy Grove retired from the company in 2000, 2001, something like that, sold off all of his stock, and Intel has not regained its highs from 18 years ago since Andy Grove quit the company. And the passive investing would systematically have underweighted Intel while Andy Grove was running the company and went up 1,000%. And as soon as he quit running the company and sold all of his stock, they would boost the allocation of Intel while it goes nowhere for the last 18 years. And so to me, this is the idea that is passive is just false, first for one, and then secondly, that's the last thing I'd ever want to do with my money is systematically underweight these owner-operated companies.
Wow, fascinating. So what effect do you think these price-insensitive buyers are having on the broader market, especially, the top end of it?
Yeah, I think they're, the market is basically the broad stock market. Passive flows have had a lot to do with the market performance, but it's also been not just passive. To me, it's price insensitive buying on all levels. So it's passive investing. It's also stock buybacks. You see a company like GE who's bought back tens of billions of dollars of its own stock at prices that are several 100% above its current price. Stock buybacks are totally price insensitive also these days. And then you have price insensitive buying of all kinds of assets on the part of central banks, whether it be the Bank of Japan, European Central Bank. And so price insensitive buying on all those levels have been really what's been propping up the markets over the last several years.
Yeah. So, Jesse, I want to ask one more question about ETFs and passive investing. But before I do, I want to pick up on something you just talked about there about stock buybacks. So I think in one of your articles, you quoted the Bloomberg stat that over the last 20 years, between buybacks and takeovers, it's like $5.5 trillion worth of equity has left the stock market. Why do you think this is important, and what effect do you think it's had on the market in the last 20 years?
Well, there's a lot of claims that I've seen. I mean, I think the first person I saw say it was Ray Dalio a few years ago, that stock buybacks have been the single largest source of demand for equities over the past 10 years. And when you see that, wow, that's, $5 trillion worth of demand, that's, a pretty big deal. At the same time, you see volume across all of these exchanges has gone way down. So there's a lot less buying and selling on the exchanges, and then a ton more buying on the part of buybacks. And I really think, to me, that's maybe your listeners have seen the chart recently of the plunge in the smart money index, and I really think that's what's behind the plunge in the smart money index is real investors are selling. And just to explain what the smart money index is, it's essentially the difference between the opening hour of trading and the last hour of trading. So you have a lot of, if you have buying in the opening hour and selling in the closing hour, the smart money index is going to go down. And companies are prohibited from buying back stock either in the last half hour or last hour of trading. I'm not sure which one. And so when you see a lot of this net selling just happen at the end of the day, and it persists over longer periods of time, to me that's a sign that investors, real investors are net sellers, and buybacks are just prohibited from buying into that supply at the end of the day. So it's a really interesting phenomenon, and it really comes back to this corporate credit cycle too, that with interest rates rising, there's another thing I think Ray Dalio talked about recently, is it's been leveraged buying in the stock market over the past few years that's been driving prices. So whether you have investors buying on margin or companies borrowing money to buy back stock, it's leveraged on both sides. And so with rising interest rates now, we're possibly starting to see some of that demand on both sides. We saw margin debt drop pretty dramatically in October, and stock buybacks are also waning, and that could just be a function of the cost of that leverage going up. So it's just stuff to pay attention to.
Yeah, it's really interesting. Now, to get back to the ETF question, one area of passive investing that has interested us is the liquidity risk. And every time we've had an ETF provider on the show, or someone who's in support of them, they've told us that our concerns are misplaced. But really, we've never really got a satisfactory answer to it. So we're wondering if you can give us your 2 cents. But the concern is really that given ETFs are open-ended, if there's a panic selling of the ETFs and then of the ETF units, and then the market maker, the ETF provider, is struggling to sell the underlying shares, but just because there's a 2008, 2009 like panic, wouldn't that create a liquidity risk for the ETFs? Is our concern misplaced? Is that a real possibility?
I think it's a possibility. I think that we've never seen the markets, how the markets would handle. I guess we have in small doses. We've seen some flash crashes over the past a few years, whether it was, August of 2015, I think was the last one where we really saw some problems in ETFs. They're very short-term problems, and really, I'm not too worried about these ETFs where the underlying products have a lot of liquidity, like stocks. I think where the concerns are most acute are where you have a liquidity mismatch, where whether it's buying a leveraged loan ETF, where people don't even realize. I think sometimes trade settlement on a leveraged loan is like 2 weeks. I think a lot of people buying corporate debt ETFs, junk bond ETFs, have probably never traded a corporate bond in their lives. I mean, I've actually tried to try and put an offer out for corporate bonds where you literally just put the offer out there, like very close to, at the market price. You put an offer out there to sell something, and it just expires day after day. You have to just put the order up because there is no buyer in a normal market, in a normal, healthy operating market. There's no buyer for that corporate bond. And so I'm more worried about those ETFs where there's a major mismatch in liquidity. So you can buy and sell a corporate bond ETF, all day long in nanoseconds, but the underlying bonds don't trade nearly as frequently. And so there's to me, that's where I think there's a potential problem. If you do see, and we have been seeing some big selling in these corporate bond ETFs. And, it could eventually get to the point, if the selling gets big enough, where they just, and we actually saw that with the mutual fund. I think it was the Third Avenue junk bond fund in 2016, early 2016, and they had to shut the fund down and just put it into liquidation because they couldn't sell the underlying assets quickly enough to meet redemptions. So they had to essentially bar, redemptions for a period of time until they could liquidate over time those underlying securities. So I think as long as you're talking about ETFs that are covering very liquid markets, then I don't really have as much concern as some of these other ones.
Was that satisfactory enough for your end?
Yeah, it's interesting. I guess the concern is more if the ETF provider has to wear the losses, and then their Vanguard and stuff, they'll be fine. But some of the smaller ETF providers that don't have as strong balance sheets, if they have to wear all these losses from the market collapsing and having to try and sell the underlying units, I guess that's where my concern is.
Yeah, and I do. I don't have enough expertise in the area to really. I don't trade a lot of ETFs. But it is my understanding that it's a lot of algorithms that are arbitraging these things that provide the liquidity for a lot of these ETFs. And, if the algorithms kind of step away, and who knows how they're programmed, but, they could be programmed in such a way that, if losses accumulate to X amount, they just step away. Then, liquidity for those markets could evaporate. It's something that we've only seen in very, very small doses. Like I said, in a couple of those flash crashes, and you saw some of those big major ETFs, traded prices they should never have ever traded at. I mean, very, very far away from fair value. And I believe they busted those trades and made everybody whole, after the fact. Even the guys who made huge profits, on taking advantage of those bad prices. So yeah, I mean, during an extended market decline, how they deal with that, I don't know.
So Jesse, let's move away from equities and into another topic that you discuss quite often, and that being gold. We've previously heard you quote Ray Dalio, "If you don't own gold, you know neither history or economics." And you've recently written some articles titled "The Perfect Storm for Gold Developing" and "Gold Fireworks on the Horizon." So I guess we haven't really seen a massive price movement in gold like we would have sort of expected. So are you still bullish on gold? And if so, why is that the case?
Yeah, I'm very bullish on gold for a number of reasons. I think, my time frame for a lot of these things is multi-years. And so, I started buying gold in the middle of 2015. And the price is up about 20% since then. So it's hard to complain that but at the same time, it really hasn't. I think gold could go to 1,500-1,600 over the next couple of years pretty easily. That's kind of what I've been expecting, and it hasn't happened yet. Really, what I for a number of reasons I like gold. One, I think it's the U.S. fiscal situation is deteriorating. We're seeing a widening, fiscal deficit during an economic expansion. That's very rare. That's something that doesn't normally happen. Usually the dollar is very highly correlated to the deficit too. So deficit widens, dollar goes down. And so how do you protect yourself when your federal government is behaving this way, right? I want to own something other than the dollar. And then you go, okay, well, Japanese are printing yen like crazy, and the European central bank's printing euros like crazy. Gold is, an alternative currency in my mind, and so that's one of its values, and as an investment, and it's a currency that can't be, really debased, and so to me, that's why I want to own some in normal times. But I do think it's important to own it now because of these things, and I do think that mid-2016 when interest rates saw their lows was probably a generational low in interest rates, and so and in interest rates and in inflation, and so if interest rates and inflation have bottomed and are also now in an uptrend, gold, it's probably a good idea to own gold in that type of an environment too. So those are just some of the reasons why I like it right now.
At the start of the year, Alec and I did an episode on bold predictions for 2018, and mine was that gold would hit 1,500 by the end of the year, but it sounds like I'm a couple of years away from that. To quote you, you say, generally, I believe it's important for investors to have significant exposure to real assets like gold at all times, if only for the purposes of diversification. Practically speaking, what do you classify as a significant exposure in percentage terms, if you can say?
In real assets, so I wouldn't necessarily say, this would be all gold, right? I mean, real estate, Treasury inflation protected securities, commodities. I mean, gold is one of my favorite. Gold and real estate are probably my two favorites out of those. But, real estate is also very highly valued today, along with everything else. So, I would say that when you look at the great asset allocators, whether it's David Swensen, the Yale Endowment, to, Rob Arnott, or, anybody else, when you look at their kind of permanent portfolios, they all have, something close 20 to 30% in real assets. And that's something that, is not in a 60-40 portfolio. And I really think that's the major missing component, is people just focus on financial assets and then don't, and completely ignore real assets. And that's, problematic. I would say, having a third of your assets in real assets, is not a bad thing by any means, or even making an aggressive call. Now, I personally think it's time to be overweight real assets for these reasons I mentioned before. But I think Dalio said you have at least 5% of your portfolio in gold at any given time, but it really comes back to somebody's risk tolerance, too. And people say, do you want to own gold physical, or do you want to own the mining stocks? And, that also just comes back to your risk tolerance, too, because, the mining stocks are a lot of times just a leveraged play on the gold price. If you're a more aggressive investor, you might focus on the miners. If you're more conservative, you might just focus on just, a gold ETF or something.
So speaking of ETF, two-part question. What's your strategy buying into gold at the moment and going forward? And also for the beginner investor, what avenues are there to actually get access to gold other than going out and buying a nugget and putting it in a safe under the bed? So how can one get access to gold?
My favorite vehicle right now for the majority of investors is I think it's called the Sprott Physical Gold and Silver Trust now. It used to be the Central Fund of Canada. And essentially they just own physical gold and silver. But this is a closed-end fund. and it trades at about a 5% discount to the precious metals they have in storage. So it allows you to buy gold and silver at a 5% discount to the market price, first of all.
Wow.
The other thing that's cool about this is Sprott, when they took over this fund, they added a redemption feature where you could actually convert your shares to bullion. So if you say, you know what, I'm worried about Sprott, I'm worried about whatever, I just want to own physical for some reason, you just go to Sprott and say, convert my shares to bullion, and they will give you coins or, whatever it is. And so There's really zero reason. I don't know why somebody hasn't arbitraged this away, right? Just go buy a bunch of shares and then say, now convert it to physical, and I'll go sell the physical somewhere else and make the 5%. Nobody's done that, but this is a great opportunity, I think, for individual investors to take advantage of a way to put some money in the portfolio into precious metals at a good price.
Mm-hmm. So, Jesse, we know we've taken a lot of your time, and we're about to get to the final 3 questions we end every interview with. But before we do, I want to ask one more question. Given what's happened in crypto markets recently, what are your thoughts on crypto as an asset class? Is the boom done, or are we in the sort of post-boom dog days before a recovery? A la tech in the mid-2000s?
Gosh, I've talked to, this is interesting, it was a year ago, I talked to a few of my friends who had differing opinions on crypto, and I decided not to do a podcast on the topic. I just couldn't wrap my head around dignifying it as an investment because it just doesn't seem like a valid investment vehicle to me. And I've really tried to, understand it and look at, the merits of it as an investment, but I really just can't see it. I think, first of all, you have to be able to understand something in order to invest in it. Warren Buffett has said there are a small number of companies he can understand as an investor, and that limits his universe of things that are investable for him. And so if that's the greatest investor of all time saying that there's a small number of companies, that should tell you how many you and I are capable of actually analyzing and understanding. And then to look at something like cryptocurrency and can we really understand it? And then when people talk about the merits of it, to me, the most glaring problem is, they claim that it's limited in supply, but we've seen so many forks, and so anybody can go create a Dogecoin or, whatever else they want to create at any time. The idea that it's limited in the way that something like gold or real estate is absolutely asinine in my view. So I do think the distributed ledger technology is very interesting for a number of reasons. I really think it's going to be interesting in terms of what it does to the data economy, and possibly giving us ownership of our own data, and how that affects big companies, I don't know. But I think that's very, very interesting. But I don't think there really need to be any cryptocurrencies supporting that kind of technology. And so, to me, it's not something that can be really considered an investment. Yeah,
fair enough. I think given the crash that we've had this year, I think you've been proven right. So, look, thanks for your time today, Jesse. Every interview we end with 3 wrap-up questions. So the first one is, what books do you consider must-reads?
Well, I mentioned the Jesse Livermore book before, and I just found the title of it. It's Reminiscences of a Stock Operator. It's classic. Paul Tudor Jones makes everyone who goes and works at his firm read this book. Also, there was a newer version of a Jesse Livermore biography. I think it was Jesse Livermore, Boy Plunger, came out, which is more interesting, a more realistic view of his life, for those that are interested. I think Reminiscences of a Stock Operator is fantastic. The Market Wizards and the New Market Wizards books are terrific. I think people read those and you can see a wide variety of investment disciplines and kind of start to realize which ones kind of appeal more to you. Then I think Howard Marks, The Most Important Thing, is another just must-read for investors.
We've had, I think, 4 or 5 people now recommend Reminiscence of a Stock Operator, and we have a book club each month. So I think, Alec, we need to put that on the list for next month, because It's been so recommended.
Yeah, definitely.
Jesse, number 2, what is your go-to source for investing information?
Well, I've been really critical of social media and stuff over the last year, 2 years. But Twitter is, for me, I follow, just under 100 accounts there. And for me, it's invaluable to have, a number of people like that I respect and are sharing their views on a regular basis, sharing what they're reading. To me, that is my absolute go-to for just seeing what people are reading and what people are thinking about what they're reading.
Yeah, I think if our listeners out there have Twitter, I think your account, is it at Jesse Felder?
That's it, yeah.
Yeah, I think that's a great follow as well. I think reading what you're reading is definitely added value for Bryce and I. So, final question. If you can go back to your younger days when you were, paper trading and looking at Barron's every Saturday, what advice would you give your younger self when you were just starting out as an investor?
Well, there's a quote from the Market Wizards book, and I can't remember who said it or where it came from, but they said you really need to look at all of your mistakes in the markets as tuition at the school of trading or tuition is at the school of investing. And so I really wouldn't take back any of my mistakes or try and avoid any of them, because I really do feel like it sometimes takes making a major mistake to feel enough pain to prevent you from making that mistake again in the future. It's really hard to learn from other people's mistakes. But I think the advice that I would give myself, and this is the advice I give young people getting into the business, is if you're interested in learning and getting into the finance industry, find somebody who you really do admire, like I said earlier, both professionally and, from a personal standpoint, and just see if you can go to work for that person. Do whatever it takes to go work for that person. And that's going to be far more valuable than just, getting a job at any old firm or even, one of the big firms like I did, take some time to figure out and find somebody that you admire and then try and go, learn directly from them, because you'll learn a ton more and you'll, I think, feel a lot more fulfilled in the process.
Yeah, great piece of advice. Speaking of admiration, fanboying quite hard over here at the moment, having the opportunity to speak with you, Jesse. So it's been a fantastic start to a Saturday morning for us. Really appreciate you giving us your time and coming on the show. I know, as I said at the start, we've been following you for a while now and can really resonate with a lot of your ideas and thoughts on the market. And, I hope our listeners have got a lot out of the interview today, because I know Alec and I certainly have. So just a massive thanks. For all our listeners, Jesse runs the blog, The Felder Report, which is worthwhile signing up to, and also has a podcast, Superinvestors and the Art of Worldly Wisdom, also worth a listen. For our listeners, Jesse, where can we find you on social media? Just on Twitter or anywhere else?
Really just on Twitter, yeah. No, I deleted my Facebook and Instagram accounts a while ago. Actually, I don't even have a smartphone or an iPad or anymore. Maybe I'm paranoid, but I got rid of a lot of that stuff.
Wow. So what do you do? Just the laptop and away you go?
Yeah, the laptop and a landline. I'm old school now.
Oh, great. That's good. Well, unless you have any other final questions, Ren, we'll wrap it up there. Do you have anything you want to add?
No, I think just a massive thanks, Jesse, for giving us your time and sharing some of your thoughts.
Well, thank you guys so much for inviting me. It was my honor to do this, and I want to wish you guys a lot of luck. It sounds like you guys are doing a good thing, and I hope you guys have a lot of success in helping your audience all become better investors and learn and progress and all that. So, thank you.
Hey, equity mates. I really appreciate the support and love that we get from all of you guys. Obviously, we are doing this for free. We don't expect any money from anyone, and we do it for the love of investing and equities. But there is one thing that we could really appreciate your support from. Ren?
Oh, great. Yeah, look, we don't ask for money, although if you want to send it our way, we wouldn't say no. But the biggest thing you can do to help us grow the podcast, to get more people listening, is to just jump on iTunes or whatever podcast platform you use and give us a rating. Ideally 5 stars. If not, if you think we're only worth 3, then that's your decision. But yeah, it helps us massively in the ratings and to get more listeners and to grow the brand.
Nice. Leave a review and also tell your mates.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.